Maybe Katie Wood was right to keep buying unprofitable speculative technology stocks for her ARK investment management ETFs as the prices plunged. Last week, ARK's main fund recorded its best 4-day streak since its launch in 2014, leaping more than 25%. The outsized gain wasn't thanks to Miss Wood's investment acumen, since ARK Innovation remains down almost a third this year alone, but it is indicative of two interconnected issues that matter hugely to investors: rising interest rates and whether to buy the dip. On the face of it, the Federal Reserve plans to raise rates rapidly are terrible for stocks and even worse for unprofitable tech shares, since speculation generally thrives on cheap money. There are two reasons you might be tempted to buy the dip. The first is that the longest dated bond yields come down as the Fed tightened, and that means far off profits, so long as they proved not to be imaginary, are worth more now. The second is that stocks had already fallen a long way, which means investors were already prepared for bad news. Both these reasons need scrutiny. Let's look at the first. There is logic to the idea that 30-year yields would fall. The Fed's sharp rate increase now should slow the economy, means less inflation, so less need to raise rates aggressively later. That's what Fed policymakers think will happen. Their own predictions show they expect to raise rates now so that they can cut them later. Their median forecast is that interest rates will rise to 2.8% by the end of the next year, from 0.25 to 0.5% today, before falling back to a long-run rate of 2.4%, and the market, broadly speaking, has bought the idea. The 10-year yield is lower than the 7-year, while the 30-year Treasury yield is smack on the 2.4%, the Fed predicts. But this is an altogether happy state of affairs. Bond yields retreat because inflation stops being a problem. Bond yields could also fall because of a recession. The former is great for shareholders, recession not so much. The historical record is mixed. There are plenty of recessions caused by the Fed, but in the mid-1960s, mid-1980s and mid-1990s, rate increase cycles came to an end without recession. The economy had a soft landing. Had the pandemic not struck, the Fed might have engineered a soft landing with its rate cuts of 2019 too. The bond market's best signal of imminent recession is the shape of the yields curve, and it isn't yet flashing warning. The 3-month yield remains far below the 10-year yield, while typically before a recession it rises above the longer dated yield. It's true that there are good reasons to worry about recession, with household spending power hit by inflation, sanctions creating financial stresses, and geopolitics adding to the troubles for globalization. But there are reasons to be sanguine too. With post-pandemic savings able to absorb some of the hit to household spending power, European governments are about to embark on a belated post-COVID-19 spending spree. Banks strong and vast amounts of cash still sloshing around. You could even argue that the Fed isn't cooling the economy that much. Consumer price inflation rose by more than 3 times. The Fed's quarter-point rate hike last week. If, as economists believe, it is after inflation interest rates that matter to the economy, the Fed has actually eased monetary policy this year. Though we shouldn't get too cute about this, talk of future rate rises matters to the economy too. Bottom line, there is a strong case both for and against a stagflationary recession ahead, and it's hard to disagree with either. That suggests to me more wild market swings ahead, as data points to one outcome or the other becoming more likely. The second reason you might buy the dip has been big. The big tech-dominated Nasdaq 100 and Russell 1000 growth indexes fell into a bear market on Monday, down more than 20% from the last year's peaks. But I remain doubtful that Monday's stock market low marks the start of a bright new bull market. First, those who choose to buy tech stocks because the fall was a nice round 20% are hardly making a considerate judgment on the fundamental outlook for the risk and reward. Second, the biggest gainers have been unprofitable tech beloved by Miss Wood, and meme stocks such as GameStop and cinema chain to gold miner AMC Entertainment, hardly the foundation for a solid market. And third, the Fed is less likely to ride to the rescue of the stock market if it does fall further, because of the importance of bringing down inflation. The lack of Fed backdrop makes stocks riskier than they were. So deep buyers beware. The 30-year mantra of buying because the Fed will intervene to help no longer applies. So you'd better be sure Miss Wood has it right this time.